welcome to my channel today. This is the King's Tutor. If this is the first time of joining us, kindly like, comment, share, subscribe, and thank you for joining us. If you're a returning subscriber, thank you for your support so far. Okay, so today we want to see a question that relates to single entry and incomplete records. Okay, now in this channel we have treated single entry and incomplete records. We have treated introduction. So I will recommend you watch those videos. I will leave the link below this video in my YouTube channel. Okay, so I want to see a question that relates to incomplete records. And the question said, Mr. Harrier, a businessman, maintains his books of accounts on double entry. Now, some of his books of accounts covering the year to 31st December 2008 were accidentally destroyed, and you are asked to prepare a final account for 2008 from the records that are available. It has been possible to establish the amount of assets and liabilities as follows. Okay, now these are the amount of assets and liabilities. Now we have two dates. Okay, now we have fixed assets given for the two dates. We have stock, debtors, bank, creditors for bank purchases, creditors for bank expenses. Now additional information said no fixed assets were acquired in 2008 and none were sold or discarded. They are to be written down at an annual rate of 10% on the balance at the beginning of each year. The second additional information said during the year 2008, he withdrew 5,500 Ghana cedis, okay, at the end of each half year for personal expenses. Now, remember, he said he also won a lottery of 10,000 Ghana cedis, for which he subsequently introduced into the business. Now, we have treated something like this. We said this the first part of the question can come, okay, when you are preparing showing the profit or loss from two balance sheets. Okay, now I've treated that introduction part and how to understand. So, okay, for effective assimilation, I recommend you watch that. Check in my link below. I will keep the introduction of this there. Okay, so that you can understand better. Now, we want to start solving. Now, we want to solve from two balance sheets. So, what we have to do is to prepare the statement of affairs using these two dates that are given. We are going to get the opening capital and the closing capital. After we prepare statement of profit or what or loss. Okay, and the opening capital will be gotten from the one from the earlier year. I said the statement of affairs and a brief balance sheet, the same way you prepare your balance sheet. Okay, so we are going to do this now. Now using the first state. Okay, so we have fixed assets. So we are going to post here fixed assets. 500,000 Ghana cedis. We have stock. This aspect of assets, 9,145 Ghana cedis. We have debtors, 14,805. We have bank, 6,620, and okay, that's all for the assets. Now let's go to the liability side. So we have our liabilities. Now we have creditors for bank purchases. Creditors, let's just write for bank purchases. How much is it? 11,365. And we also have creditors for bank expenses. We have creditors for bank expenses. We have 445. Okay, so this you're supposed to have the same balance. So what do we do in this situation? We're going to add this part and subtract this from it. Now the balancing figure will not give us the capital, which is the opening capital, since it is what the opening year. So we'll have here what we call our opening capital. That is the reason for preparing this. So if we add up this right hand side, it will give us 530, 570, this is supposed to be, let's say, 530, 570. Okay, now subtract it from the total here. You have 518, 760. That's our opening candle. Okay, so that is for statement of affairs using the first date. Now we are going to the second date. Statement of affairs at 31st. Now we use this one below. And remember, since it's 31st, we're going to check the additional information. This is where most of the items will be applicable. Okay, so we have fixed assets. They said see below. Now they made a recommendation for fixed assets, and they said no fixed assets were acquired in 2008 and none were sold or discarded. So they said none were sold or discarded. Now let's see what they are saying. It had to be written down at an annual rate of 10%, calculated on the balance at the beginning of each year. Now, if we are to calculate at the beginning of each year, we are talking about reducing balance system. Okay, so it means that the fixed asset was has depreciation. Okay, so we are going to calculate it. They say at what 10% each year. So I think we are preparing for more than 1 year. We are going to do or reduce balance. Okay, so we are going to calculate 10% on 500,000 for the depreciation. Is 10%, that's 10 over 100 times 500,000. So it is what? 50,000. So the depreciation is 50,000. So it means our fixed assets now, we have cost here, depreciation, and net book value. So our fixed assets, the cost from this part, because they say none was purchased or discarded, the cost is 500,000. And the depreciation is what? 50,000. So the actual value now is what? 450,000. And actual value of the fixed asset. Okay? So that is that. The next one is stock. It is given here. Stock as what? 2685. Let's cover this. 2685. The next one is debtors. Debtors is 15640. The next one is bank. 6505. Okay. The next one is, okay, that's all. So if we add this now, this will give us 42,830. Okay. I'll cover here also liabilities. Same creditors for bar purchases. The amount is 10,920. And we also have creditors for bar expenses. The amount is 515. Now these two are supposed to have the same balance, so that the balancing figure becomes a closing capital. So if you add the right hand side here, it gives us 492,830. So they are supposed to have the same balance, 492,830. Okay, so I recommend you also watch the previous video. I said that before, so that you can easily get a simulation. Okay, so our closing capital is now this is subtracted from the total, which will now give us 481,395. Okay, now we now have the opening capital and closing capital. Okay, now I gave a format in the video to prepare statement of profit or what or loss. Now in this situation whereby we are going to compare the closing capital and the opening capital to see the one that is bigger. Okay, if the closing capital is more, it means there's profit, but if it is lesser, it means there's loss. Okay, I gave the format in the previous video. So we have the closing capital. The closing capital is 481,395. Okay, now the next is to add drawings. If you check here, it said during the year he withdrew 5,500 500 at the end of each half year. Each half year, it means for 6 months. So for the full year, it means it is 5 multiplied by 2. Let's say each half year. So for 6 months, 5. For the other 6 months, 5. Make it complete 1 year. So I'm saying drawings is 5 times 2 because for 1 year, say each half year. So it will give us 11,000. So if you add up, you have 492, 395. So say less opening capital. Opening capital, which is 518,760. Okay, so the opening capital, if there's additional information, we can add it. Here they said he also won a lottery of 10,000 Ghana cedis, which was put into the business. So that 10,000 was an additional capital. So we say additional capital 10,000. That was added. So if we add that, we have 528,760. But we notice here that the closing capital was less than the opening capital. So that means it made the loss of 36,365. That's the loss. The loss of 36,365. And it being the closing capital was more than the opening capital, it means the profit. But since it is less than the opening capital, it means that is what? A loss. Okay? Because the capital used in the business at the beginning was higher than the balance that was made at the end. Okay? So that's how we solve this question. Okay? So I ensure you are not subscribed to our channel. Ensure you subscribe so that you know when we upload more of this kind of video. Okay? And ensure, please do me one favor. Please ensure you like this video, like it, and comment below. Okay? So that we reach more students. Okay? Thank you very much.